Welcome to TheoTrade. This is Don Kaufman. June 15th, 2020. Seconds to go to the cash close here on this Monday afternoon with just a downright wild range inside of the broader market today. I mean, hey, if you're tuning in right now, sure, the S&Ps are up, I would say kind of a meager 26 points or 0.88%. And we're pulling out a very, very mild up move today. But the overall range, and you got to include, of course, some of the overnight trade. I mean, at one point overnight, the S&P's traded all the way down to 29.23. Took off to the upside. We've seen a print as high as 30.68. I mean, net, where are you at? The range on the trading session is 144, and a half handles. 144 point, there's the closing bell, 144 point move. Now, the reason that this is so important, and you might think, whatever, it's just a big trading day. Now, this is what's critical right now, is to understand that at times the marketplace has very efficient moves that are well inside of what you would expect. And then there's times where the marketplace just throws out, just wicked and woolly moves. And I'll remind everybody that on the weekend update, we were talking about expected move. An expected move for the entire week was right around 125 points higher, or 125 points lower. Today, we already threw off a range of approximately 144 points. Now, granted, market wasn't necessarily open. Some of it, persisted in the overnight trade. Yeah, but even since the marketplace was open, and again, this is like a really critical aspect. We've traded all the way down to 29.65, as high as 30.80. Again, you're looking at well over 100 handle move inside of the SPX, and that's during trading hours. So one thing. Overwhelming theme, a wild range like this is absolutely indicative, of a wild marketplace. Now, does that constitute that we're going to rally, we're going to sell off? That's what we're going to dig into here momentarily. But I cannot reiterate enough, right? You see a range of over 100 handles in the S&Ps, It doesn't matter whether it's the upside to the downside. A lot of this range today, was, again, we were already consistently moving to the upside. We broke off of what's called a 29.83 gravity point. We got a little bit of a kick in the pants from the Fed. For those of you who are like, what exactly does that mean? Right here. That's when the Fed actually stepped in. The Fed, they can't keep quiet. Come on. Last Thursday, we sold off big. They had to say something. The Fed is going to come out now, and they're officially starting their corporate bond buying program, which, if you're not aware, was announced months ago. It is re-announced that they were going to start doing junk bonds. They initiated the junk bonds. And finally, this is like an announcement that's been announced a multitude of times already. And finally, we're going to kick off with some of the corporate bond buying, which, I won't state I'm just not a huge advocate of the idea of buying some of the corporate debt out there and allowing degenerative borrowing. It gets even better than that. Of course, as soon as you start buying corporate bonds, many of the companies are going to go out there and they're going to load up on debt and probably buy back some of their own stock with that debt. It's a brave new world, people. So the wild range, again, indicative of wild markets. Obviously, the Fed propping up the market once again, getting us on the bid right at the 11 o'clock hour Pacific time. But let's actually take you into a little bit of a bigger picture. One of the first things that I want to mention before any risk on, risk off, push all that aside for a second, I want to cruise out to 180-day 4 hour. This is 180-day 4 hour. Now, listed on this particular screen, obviously, is the S&P futures. So I wanted you to see the S&P futures because that's what drives order flow to the marketplace, right? And on this particular page here, we've got all of our gravity points from 29.83 to 29.11, 28.42, and so forth and so on. But what I really wanted to zoom into, and that's of critical importance right now, is the fact, and I'm just going to box this out, that we, at this point are technically not inside, okay, of the volatility box. One of the things that I was mentioning on the weekend update that I think it's critical in the days to come, literally the days to come, hours to come. All right, if we're to drop back below, again, this level is 29.83. If we're to close below that level, it puts us back inside what was a wicked volatility box that persisted all the way from April, okay, till literally like late May. Only, 3 weeks ago when we actually broke the upside of the volatility box, we came up, we fell smack back into it. We just rallied back out of it. So you really got to keep in mind this 29.83, because if we do slip back, all right, we're likely to see very persistent and elongated moves, okay, from gravity point to gravity point. And that's why I was just mentioning the gravity points there moments ago. That's what you want to pay very careful attention to in just the next few days to come. Is again coming under 29.83. Then we're just going to ping back and forth 29.11, 28.42, ping back to 29.11, right, and expect some very fast, very chopped out trade. Now, that unto itself, okay, is at least at this point a bit of a bullish indicator. I know, I can't believe I'm going to say it. In the very, very short term, closing today above, okay, the 29.83 is a relatively bullish indicator. However, okay, there's a little bit of a contrarian indication on the screen, and I want to take you specifically into that. Yes, I see that the S&P's rallied today, but one of the things that really stands out as the S&P's rallied, the bonds, they didn't back off. They just didn't back off, which it didn't provide, okay, much movement to the upside. Yeah, in terms of the financials did close up approximately 1.4%. So they got a little bit of a bid under them. But net, what I'm getting at here is because the bonds didn't back off, it doesn't exactly give me a warm, fuzzy feeling about the S&Ps or a warm, fuzzy feeling about, of course, the financials. And we know that if we're going to continue to kind of propagate gains in the S&Ps, we're going to need the financials behind that. Again, the line in the sand that I would look at between just a pure bullish market and a marketplace that's going to be in trouble, if you were to look at the XLF once again, okay, is 2650. Now, this is not a new number. This is a number we've been mentioning, okay, constantly, literally for years now. And in the middle of the crisis that we're seeing, okay, we're still well below the 2650 level. Nevertheless, okay, one of the bothersome points out of today's little rally to the upside is that rally was in large part brought to you by, okay, a lot of the Nasdaq. Sure, the financials participated, but the financials don't have a leg to stand on because the bonds just kind of refusing to back off. Now, at the same time that the bonds are refusing to back off, I'm also a little bit concerned, okay, given what we're seeing in terms of the overall structure of volatility. Volatility, it's still in a very, very guarded stance. Like, sure, I know a lot of people are looking at volatility futures. The problem, though, with the volatility futures that you're looking at on the screen, okay, and again, I'm not a big advocate of the VIX, so don't even worry about it. But if you are looking at the VIX, you can even point out, well, yeah, the VIX barely backed off with the market higher. It's the volatility futures, though, that are the tangible tradable product. And when it comes to volatility futures, you can't look, all right, at the front expiration because there's only 2 days left to live. So you got to go out a little bit further, right? A little bit further in time, and that's the VX, okay, N20s. So pull that little monkey up. They've got 37 days left. And what I wanted you to see, all right, is again, they backed off, but it's negligible. It doesn't even count. It's like, 1.5%. So what gives, right? You had a marketplace rally, or you have the S&Ps that are still, propagating gains outside of that volatility box. But the bonds, they don't give up an inch. I mean, really, if this is going to be a real rally, you got to get those bonds all the way back down, maybe even to the 175 handle. Okay, if this is going to be a real rally and we're going to have, persistent upside movement, you need those volatility futures to drop, and they need to drop like a rock, and they're anything but dropping right now. So we're highly guarded. Okay, interesting irony here is if you looked at even like short-term volatility, this is the 9-day VIX. it lost less than 1%. Okay, the VVIX, the VVIX came down, but it came down from astronomical levels of like 170, and here we are. We're still, again, at about a 141 VVIX. That's the volatility index. Okay, all of this together. Again, there's some conflicts in terms of the tape. Yes, okay, again, the S&Ps are outside the volatility box, but at the same time, bonds are not backing off. Volatility is not backing off. Okay, the financials rallied today, but they rallied again on nothing more than a little bit of a bid under there. We're not getting, again, real heavy buying inside of those financials, because if we were, the bonds would be backing off. Right now, again, you have to look at the range that we saw as warning shots being fired. Okay, and I cannot stress this enough. You know, a wild range in the S&Ps like this, that is, again, it's not indicative of good things to come. I mean, again, we're not having the quintessential rip your face off rally. And I think a lot of people right now are looking at this marketplace. They're like, well, it's a good thing we didn't get crushed by another 100 points. Yeah, again, but the range absolutely speaks volumes. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.